Ladies and gentlemen, listen closely because what I'm about to tell you could change the way you think about your wealth and your security right now. Something huge is happening at the LBMA and COMEX, the two most important gold and silver markets in the world. And if you own gold or silver, ignoring this could be catastrophic. This is not speculation, this is reality, and it's unfolding as we speak right now. What's happening to the global gold and silver markets is nothing short of alarming. The London Bullion Market Association and the COMEX, the two most influential centers for trading precious metals, are sending signals that most investors either don't understand or are simply ignoring. These are the institutions that set the benchmark prices for gold and silver, yet the activity behind the scenes is increasingly disconnected from the physical reality of the metals themselves. The majority of traders, analysts, and news outlets talk about these markets like they're stable, orderly, and predictable. The truth is far more disturbing. Paper promises are dominating physical realities, and if you own gold or silver, this is something you cannot afford to overlook. Let's start with the fundamental problem. The LBMA and CX operate primarily as paper markets, which means that the vast majority of gold and silver traded are not physical coins or bars changing hands, but contracts and derivatives. These contracts are often leveraged, meaning a relatively small amount of actual metal can back enormous sums of paper claims. On a normal day, that's manageable. But the moment a large number of investors suddenly decide they want to take delivery of real physical gold or silver, the paper system can break down. And history shows us that when the paper market diverges too far from physical reality, prices can spike violently, sometimes overnight. We've already seen hints of stress in these markets. Inventory reports, delivery failures, and unexplained delays in the transfer of physical bullion are not mere administrative hiccups. They're red flags. The LBMA, which clears the majority of gold traded in London, has been showing signs that physical stockpiles are under pressure. At the same time, COMEX, the largest futures exchange in the U.S., has seen increased activity in futures contracts with little corresponding movement in actual metal delivery. This disconnect is dangerous because it means the market is increasingly driven by speculation and not by the real supply and demand of physical metal. The implications of this shift are profound for anyone holding gold or silver. Owning paper gold or silver through ETF certificates or futures contracts is not the same as owning the physical metal. When the paper market experiences stress, the owners of these contracts may find that they cannot convert their claims into actual bullion at the agreed upon price. That's not hypothetical. It has happened before, and every time it does, the consequences for investors are devastating. People assume that if they hold a claim to gold or silver, they are safe. The reality is that you are only as safe as the institution backing that claim, and the LBMA and COMEX are showing signs of strain. This isn't just a theoretical risk, it's a structural problem embedded in the way these markets operate. The LBMA has long acted as a sort of central clearing hub for gold, facilitating enormous daily flows of metal between banks and other financial institutions. But as physical demand rises, whether from private investors, central banks, or even governments, pressure builds. If too much demand hits the system at once, there simply isn't enough bullion to satisfy everyone. COMEX similarly allows traders to enter contracts for gold and silver that they may never intend to take delivery on. That works fine in stable conditions, but when the market is shocked by a spike in inflation, a currency crisis, or geopolitical uncertainty, the paper claims can far outstrip available metal. The result is chaos, price spikes, and potentially widespread panic. And make no mistake, we are moving closer to that kind of environment. Central banks around the world continue to print money at unprecedented rates, adding trillions to global debt and diluting currencies. That makes gold and silver more valuable as a hedge, which increases demand for physical metal. Yet the paper markets, the LBMA and CONX, remain dominated by leverage and speculative contracts. It's a classic setup for a disconnect. The more people realize they need real metal, the more the system will be stressed. And when it breaks, it's not going to be subtle. Paper prices could diverge wildly from the cost of physical bullion, and investors who think they are exposed to gold or silver without holding the real thing could be left with nothing but a piece of paper. The lesson here is clear. If you own gold or silver, you need to be aware of how these markets operate and how shifts in the LBMA and COMEX affect you. It's not enough to rely on charts, news headlines, or promises from brokers. Physical ownership matters. Secure storage, verified delivery, and control over your assets are more important now than ever. The signals from these markets are urgent. Supply is tighter than most realize. Demand is rising, and paper markets may not be able to handle the stress. Those who wait too long to act could face painful consequences. This is why timing is crucial. Investors often tell themselves they can buy gold or silver later when prices dip or after the market stabilizes. That's the mistake. The moment you wait, you risk entering a market where physical metal is scarce and prices have already surged. The news coming from the LBMA and COX is not just technical financial reporting, it's a warning sign. Every investor who truly values wealth preservation must pay attention now. The actions you take or fail to take today will determine your financial security tomorrow. At the end of the day, the global gold and silver markets are showing cracks. The LBMA and COMEX are not just neutral venues. They are operating under conditions that could dramatically affect the availability and pricing of precious metals. If you own gold or silver, it's not enough to hope that everything will remain normal. You have to understand the structure of these markets. Recognize the risks and make decisions based on reality, not fantasy. Physical ownership, careful planning, and awareness of market shifts are no longer optional. They're essential. The writing is on the wall and the signals are loud and clear. If you choose to ignore them, you do so at your own peril. If there's one lesson the past century has taught investors, it's that paper money is not wealth. It's a promise, and promises can be broken. Governments can print more, banks can create credit out of thin air, and currencies can be devalued in a heartbeat. That's why gold and silver are not just commodities, they are insurance. They are real wealth that cannot be created out of nothing. And today, as central banks around the world continue their reckless money printing, the value of holding tangible assets has never been more clear. Let's start with the mechanics. Inflation is not just a rising price of groceries or gas. It's the erosion of purchasing power. When central banks expand the money supply, every dollar, every euro, every yen you hold buys less tomorrow than it does today. It's subtle at first, often invisible, but over time it becomes devastating. Gold and silver, on the other hand, do not depreciate in the same way. They have intrinsic value. You cannot print gold. You cannot manufacture silver. They represent real wealth, and that's why they have been trusted stores of value for thousands of years now. Some investors still cling to the idea that holding cash or bonds protects them. They believe they can beat inflation through nominal returns or trust that the central bank will maintain stability. But history is brutal. No fiat currency has survived unchecked printing indefinitely. Governments may talk about stability, but when the money supply expands faster than the economy, the system is doomed. That's where gold and silver come in. They are immune to the whims of policy. They do not promise returns, they preserve purchasing power. And in times of high inflation, their value relative to paper money skyrockets. Look at the last few decades. Every period of significant money printing has been accompanied by a rise in precious metals. When people lose faith in fiat currencies, they seek alternatives. Gold and silver have always been the default, and it's not just a historical curiosity, it's a predictable outcome. Money is just a tool, and when the tool becomes unreliable, people turn to something that has maintained its value over millennia. This is why in any environment where governments are piling up debt, printing money, or devaluing their currencies, holding gold and silver is not speculation, it is a rational act of preservation. Silver in particular deserves attention. While gold often gets the headlines, silver has unique characteristics that make it a powerful hedge. It is both a precious metal and an industrial commodity. That dual role means its demand comes from both investors and industry, creating a floor under its value that pure fiat cannot replicate. And unlike gold, silver's market is much smaller, which means the even modest increases in demand can lead to significant price moves. Those who recognize this dynamic today can position themselves advantageously before the broader market catches on. Physical ownership matters more than ever. It's not enough to have claims on paper. Gold ETFs, certificates, or futures contracts may reflect price movements, but they don't guarantee that you can take delivery of real metal when it matters most. In times of crisis, the system behind paper assets can fail. Delivery delays, counterparty risk, or even regulatory interventions can leave investors with little more than a promise. Gold and silver that you hold in your possession, secured and verified, are immune to those risks. That's why anyone serious about protecting their wealth doesn't just track prices. They hold metal they can control. Timing is also critical. Inflation doesn't happen in a straight line, and markets are not always rational. The signals may appear subtle at first: a rise in commodity prices, a dip in currency value, or an increase in central bank balance sheets. But the moment the market realizes the extent of the erosion of purchasing power, prices of gold and silver can move sharply. Those who wait too long risk entering the market at a much higher price, or worse, after a crisis has already begun. Every delay is a cost because purchasing power is being destroyed every day. You hold fiat currency instead of real assets. This is the essence of wealth preservation. The goal is not to make a quick profit, it is to ensure that your wealth survives. Gold and silver are not about speculation, they are about insurance, and insurance only matters if you buy it before the disaster strikes, not after. The math is simple. Money printed today is less valuable tomorrow. Gold and silver do not suffer that fate. They protect purchasing power and provide a safe harbor when the storm high. Finally, it's worth noting that this is a global phenomenon. Inflation is not confined to one country. It's the result of a worldwide monetary system that is increasingly fragile. Central banks are competing to weaken their currencies, to make debt more manageable, and to stimulate economies with artificial liquidity. But those policies have real consequences. They destroy savings, distort markets, and create bubbles that eventually burst. In that environment, gold and silver stand out as the only reliable assets. They are not promises, they are reality. They cannot be manipulated away, and their value cannot be printed. So, if you are serious about protecting your wealth, about ensuring that your purchasing power survives the reckless monetary policies of governments and central banks, gold and silver are essential. They are not trendy, they are timeless, they are not speculative, they are conservative, and they are the one investment that consistently holds value when everything else fails. The lesson is clear. The moment to act is now. Inflation is not coming, it is already here, and gold and silver remain the only safe refuge from a world where money is constantly being devalued. Holding these metals is not a choice, it is a necessity for anyone who values financial security. When it comes to protecting wealth with gold and silver, there is a distinction that most investors fail to understand, and that distinction could mean the difference between security and disaster. Owning physical metal is not the same as holding a claim on paper, yet the majority of people think that buying a gold ETF, a certificate, or a futures contract is equivalent to owning the real thing. That could not be further from the truth. In normal times, paper may track prices, it may even provide short-term gains, but when the market is stressed, when liquidity dries up, or when governments and banks fail to honor promises, paper assets are exposed for what they are: just promises. Paper, gold, and silver have proliferated because they are convenient, liquid, and easy to trade. You can buy and sell them with a click without ever handling a bar or a coin. Futures contracts allow massive leverage, amplifying gains on paper while exposing holders to immense risk. ETFs offer access to metal without storage worries. On the surface, it seems logical. Why deal with heavy physical metal when you can hold a digital representation? But here's the catch. Those claims are only as good as the institution backing them. If that institution fails, if regulatory changes restrict access, or delivery bottlenecks appear, the promises become worthless. You own nothing tangible. You have an IOU that may never be honored. Contrast this with physical ownership. Real gold and silver bars, coins, or bullion cannot be created out of thin air. They are real assets with intrinsic value, universally recognized and traded. When you hold physical metal, you have security that no paper asset can provide. If the banking system collapses, if markets freeze, or if governments impose capital controls, physical gold and silver remain yours. You can store them privately in a secure facility or even at home. Unlike a paper claim, there's no intermediary whose failure can destroy your wealth. That is the fundamental difference between paper and physical metal control. History repeatedly shows why this distinction matters. In times of financial crisis, when confidence in banks and governments erodes, those holding paper claims often find themselves empty-handed. During previous financial panics, delivery of metals promised by paper instruments was delayed, limited, or outright denied. Investors who thought they were protected suddenly realized that their gold and silver existed only as numbers on a screen or as contractual obligations. Meanwhile, those holding physical metal had access to real wealth they could trade or use immediately. The lesson is stark: convenience comes at a cost, and in the case of paper gold, that cost can be catastrophic. Leverage is another hidden danger. The paper markets for gold and silver are dominated by futures contracts and derivatives. For every ounce of metal physically available, there are often dozens or even hundreds of paper claims circulating. On paper, this looks like abundant supply, but it is an illusion. If a large number of investors simultaneously demand physical delivery, the system can't meet that demand, prices can spike uncontrollably, and those holding paper assets may discover that their contracts are effectively worthless in practical terms. Physical metal, however, is finite, real, and immune to leverage-induced collapses. Owning it is like owning a lifeboat in the middle of a storm, something tangible that cannot be washed away by the tide of financial engineering. Storage and security are often cited as obstacles to physical ownership, but these are minor inconveniences compared to the risks of relying on paper assets. Modern vaulting options allow individuals to secure metals safely with independent verification and insured holdings, and if you choose to hold metal privately in your possession, you eliminate counterparty risk entirely. The inconvenience of storing a few bars or coins is trivial compared to the peace of mind that comes from knowing your wealth is tangible, accessible, and not dependent on any third party. There is also a psychological factor at play. When you hold physical metal, you understand the real value of your wealth. Paper assets create a false sense of security because they feel liquid and flexible. But liquidity in a crisis is an illusion if the asset cannot be converted into something tangible. Physical gold and silver force you to confront reality. They remind you that wealth is real only if it exists outside of a ledger or a promise. In turbulent markets, that distinction becomes painfully clear. The irony is that in times of crisis, physical metal often outperforms paper. Investors scramble for tangible wealth when confidence in the financial system evaporates. Historically, this has led to surges in the price of coins and bars. Even when paper prices remain stagnant or manipulated, those holding physical metal can act, while those relying on paper are at the mercy of banks, brokers, and exchanges. The system favors those with control over their assets, and nothing provides control like real